Well, hello. My name is Paul Waln with the Waln Group at Remax. It's a pleasure to talk to you. In this video segment, we're going to discuss the power of leverage. This is a most often significantly misunderstood topic amongst real estate investors and would-be real estate investors. Understanding this topic, once you internalize it, it seems quite simple, but it is a little confusing for a lot of people to get their mind around. And so I want to go ahead and start off and do a quick video on exactly why it is that leverage is a key component and about the half dozen key components that make up a sound and efficient real estate investment model. So let's go ahead and get started. I want to start off with a quote from Warren Buffett that says, "Never depend on a single income. Make an investment to create a second source." Real estate investing for many people is just that. And there are a number of reasons why it can work and ways that it can work more or less efficiently. I want to talk about how to create that efficiency today, and that's what we'll be discussing. So let's talk about the power of leverage. Leverage is one of the key components, as I mentioned earlier, in having a successful real estate portfolio and maximizing your efficiency there. The key to leverage is the power to do more with what you have right now so that you can get started and you can continue to build that portfolio as efficiently as possible. So what we find is the majority of people in the United States focus on the idea of paying off their real estate. And if you look at traditional retirees, they're looking at the idea, I want to pay off my home, pay off my mortgages, that type of a situation, because they believe they're doing something that is in their best interest. When the fact of the matter is 2 out of 3 Americans are running out of money during retirement. They're going bankrupt. And that is a really, really significant issue. And we want to help as many people as possible avoid that unfortunate reality. So let's talk about why you should use leverage. So let's look at a property that's owned free and clear. So in other words, you've paid this property off. Now let's just use an academic example of a property value of $1. If you've paid it off, the amount invested is $1. You have no mortgage. The bank has not loaned you any money in this. You have invested $1 of your own money. Now, when the market appreciates by 10%, the real estate market it is, then 10 cents is equal to 10% of that dollar. You've made 10% on this investment because the market went up 10%. So far, so good. That's pretty straightforward, I think. Now, if we introduce leverage in the form of a 50% loan-to-value mortgage, that means our property value is still $1, but we've only invested 50 cents. Now, the bank has committed 50 cents to the project, and you've committed 50 cents to the project. Now, when the market goes up by that same 10% market appreciation, 10 cents is equal to 20% of the 50 cents that you have invested. You have increased your return significantly by utilizing money from the bank in the form of a mortgage. Now, if we take that one step further, this is more typical of how most people will do a new mortgage. They'll get a 75% loan to value. In other words, they put 25% down. So I've got $1 of property, which I've invested 25 cents of my own money. The bank has loaned 75 cents. I put in 25 cents. When the market goes up by that same 10%, 10 cents is equal to 40% of the 20 cents I have invested. So I've increased the return from 10% to 40% simply by using leverage. Now let's take a look at this in a different way. This is a way that I found is really helpful for people to get their mind around this and really get clarity on it. If I have $1 million property, let's just use a more reasonable example than $1. If I have $1 million property and I pay that off, I have invested $1 million in a property that's worth $1 million. If the market goes up by that same 10% we're using as an example, 10% market movement is 10% return on $1 million, which is a profit of $100,000. Now, we're suggesting with leverage, instead of paying the property off, why not use that same $1 million in equity and use it as 25% down on 4 investment properties that are valued at $1 million. So with that $1 million, I could control $1 million in real estate, or I could own $4 million in real estate. Now, this comes with corresponding mortgages, but that's where we use tenants to come in and pay for the cost of the mortgage. So now in this example on the right, where you see I've got the same $1 million invested, I can have that $1 million invested in one property at $1 million, or I could have that same $1 million in equity invested for $250,000 down payments or 25% down payments with 4 mortgages. And now when the market moves by that same 10%, I have earned $400,000 in market appreciation versus $100,000 in market appreciation. If that doesn't get you excited, I'm not sure what to tell you. It's a very exciting concept. And the idea is that we're using the same amount of money that we have, we're just utilizing it more efficiently. So the reality is when you're building that portfolio, you want to use leverage to help it grow faster. Once you're trying to get to the point where you're trying to hit that financial freedom point as quickly as possible, leverage in combination with tenants to help cover the cost of carry is the way that it works. It's the bottom line is that there are about 6 different variables, but the biggest one that seems to be most misunderstood is leverage, because we get a return on the value, asset value of the properties we own. It has nothing to do with whether or not there is a mortgage in place. The key then is that tenants were deriving income by leasing these properties out, and the tenants cover the cost of carry of the mortgage, and they move our market appreciation or asset increase due to market appreciation from a 10% market movement equaling a $100,000 return to the same 10% market movement equaling a $400,000 return. And that is about as clear as I know how to take a look at that. Now we're talking about a 10% market movement. Let's take a look at some of the major metropolitan areas that we work in. We work in Dallas, LA, Seattle, and have a lot of information about a few other places, but the bottom line is these are the places we work at most. If you look at Dallas since 2013, the market has moved 150% in the positive. Now, if you look at other major metropolitan areas, you'll see that they're typically that or better. For example, Seattle in the same time frame is over 200% market movement. But the reality of it is, if you look at the idea of how to maximize that return, we want to use leverage in order to increase the portfolio size that we control and use tenants to offset the expense of the mortgage. So how can we help you? Let's talk about our 5-year plan. We offer a complimentary personalized 5-year investment plan. And what you can expect in that is we'll discuss your financial goals, we'll discuss your current financial situation, clarify what success really looks like for you, and assess strategies to build wealth in real estate and determine which strategies are the best for you. So go ahead and make sure that you take advantage of this and sign up for your personalized 5-year plan. I love this quote. The question is not whether the formula for success will work, but rather whether the person will work the formula. And we're here to help you work that formula, define the formula, establish it, and work it efficiently, and maximize your success as a real estate investor. So I want to encourage you to go ahead and schedule a consultation. You can see here on the screen, you can sign up to schedule a meeting, or you can sign up to one of our upcoming investor webinars. I'm Paul Waln. It's been great to talk with you real quickly. We'll talk about this and many other topics that are similar and related, and how to invest efficiently and profitably in real estate in our upcoming real estate investor webinar called the 6 Pillars of Wealth. So look forward to seeing you again soon. And again, go ahead and sign up for a consultation or attend one of our webinars that are upcoming here soon. And I look forward to talking with you again soon. Bye-bye.